Thank you, Chrissy. Hello to everyone and good morning. Welcome to today's webinar where we'll be discussing the implementation of ASU 2016-14 not-for-profit entities around the presentation of financial statements for not-for-profit entities. So as Chrissy said, my name is Katie Strader. I am a manager in our audit and assurance practice out of our office located in Richmond, Virginia. I specialize in the not-for-profit and education industry and spend the majority of the time I work in that industry. There's lots of attendees today, so I'm not sure if there's still a lot of folks out there who still need to adopt the ASU, or you're just here for the CPE, but either way, thank you for joining. And just a fair warning, this is my first solo webinar, and I haven't done one in a while, so please bear with me, and we'll try to get through it as quick as we can. So the objectives of today's webinar include describing the goals and objectives of ASU 2016-14, identifying the key reporting differences that require consideration in implementing the ASU, and developing an effective implementation plan. And this ASU is the first major change to not-for-profit accounting since FAS 116, 117 in the early 90s, so it's a pretty big change. The ASU is not intended to be a complete overhaul, more to just make some updates and add some clarity to your financial statements. And really what we've discovered with the people that have adopted so far is that it's an opportunity to refresh your entity's financial statements. So just a reminder, the ASU is and was effective yesterday or now. So this means it's effective for fiscal years beginning after December 15th, 2017, and for interim periods within fiscal years beginning after December 15th, 2018. So if you have a calendar year end of 12/31, you probably already adopted, and I'm assuming most of the people on this call that have not, or webinar that haven't already adopted, have year ends of March 31st or June 30th or even September 30th. So now it's time for y'all to participate in the fun. So also just a reminder, this is a retrospective application. So for comparative years presented, you have to apply all of the provisions to both years except for the analysis of expenses by nature and function, as well as for the disclosures around liquidity and availability of resources. So that means if you do comparative, you don't need those two items for the prior year, but if you have the information, you also have the opportunity to show it. And as always, in the period the amendments are applied, if you do have any reclassifications or restatements that occur, those should be disclosed. And if your entity does go through an audit, you will more than likely have an emphasis in matter paragraph, just in your opinion, just explaining that the entity did adopt the ASU and it did have an impact on the face of the financial statements. So with that said, I'm sure you all have hopefully heard this about 1,000 times before, but an overview of the main provisions of the ASU includes the presentation and reporting of net asset classes, reporting expenses by both nature and function. There's some new and enhanced disclosures, which I'm sure you'll hear me use the word enhanced a couple times throughout the webinar. And those include the availability and liquidity of resources, which is new, disclosures around board designations, if that's applicable, disclosures around restricted net assets, and disclosures around endowment and underwater endowment disclosures. There are also minor changes around the statement of cash flows and the expiration of capital resources. So we'll go over these changes in a little bit more detail, as well as go through a number of examples for each of the items. So the first area we're going to touch base on is the presentation and reporting of net asset classes. So in current GAAP, there's three classes of net assets. So what you're typically seeing now, or previously, was unrestricted, temporarily restricted, and permanently restricted. Under new GAAP in the ASU, there's going to be two net asset classes. So what was previously unrestricted is now going to be called net assets without donor restrictions, and your temporarily and permanently restricted net assets will be combined into one bucket called net assets with donor restrictions. And one of the main reasons FASB made this change was that they felt like there was a blurred line between temporarily and permanently restricted. So they thought it would be best to combine it into one class called net assets with donor restrictions to make it a little less confusing. And so just to reiterate, there's no really change in the definition to unrestricted or net assets without donor restrictions. So your board designations are still grouped in net assets without donor restrictions. And so your presentation options on the face of the financial statements, there's a lot of different options within the ASU. So the minimum requirement is that you have to show the two classes of net assets on both the statement of financial position as well as the statement of activities. But you do have the option to go into more detail and show the different buckets within those net assets with and without donor restrictions. So now we'll go through a few examples so you can see a couple different options. So in this first example, this is the minimum requirement. So you can see in the net assets section at the bottom, it just shows without and with donor restrictions. It's pretty straightforward. What I've typically seen with a lot of clients that have adopted already is that they've decided to show just the bare minimum requirement on the face of the financial statements and then go into more detail in the notes or disclosures. But you do have the option to show that detail on the face, which is going to be the second example that we go through. So you can see here, if you go down to the net assets section, this one goes into a little bit more detail within each bucket of net assets without and with donor restrictions. So in the without donor restrictions bucket, this set of financial statements has shown undesignated, designated by the board for operating reserve, and designated by the board for endowment, and invested in PP&E net of related debt. And then with donor restrictions, you have your perpetual in nature, so what was probably permanently restricted, and then those that were temporarily restricted, such as purpose restrictions, time restrictions, and underwater endowments. And you may see that the underwater endowments is a change from where it would previously be reclassified or shown, which we'll discuss in a little bit more detail later on. And so now here's just an example of what the statement of activities could potentially look like. So previously, this entity would have had four columns for the unrestricted, temporarily restricted, and permanently restricted, but now there's just this, two with and without donor restrictions. One thing I do want to point out that we will talk about later on is the investment return net line item about 2/3 of the way down. This will probably be a change, and we will discuss in more detail later on. And so this is just one more example of the statement of activities. I thought that this example did a good job of showing how the expenses are broken out. So you can see on the side, it really breaks it out by the program expenses, which would be education in general, as well as the supporting services. And these amounts should tie to what will be the new schedule of functional expenses, which we'll discuss a little bit later on. So just note that I will say both of these examples of the statement of activities are set up to have an operating measure, but that is not required within the ASU. It's just so happened that most of the examples I found had that. There was an initial thought when FASB was doing the exposure draft to include an operating measure requirement, but FASB decided to punt that, and the ASU does not require that now. However, if your entity does show an operating measure and you reflect governing board designations, appropriations, and similar actions within that measure, you're required to disaggregate them and describe them by type, either on the face or the notes. And what that means is what we saw in the previous example, where they're going to the board appropriations for operations and then the board appropriations that aren't. So the implementation plan, what does that mean? I think a couple of these items can probably be done together, but one thing that you'll want to consider is general ledger and tracking considerations. Are there going to be any changes to how you're recording things in the GL or how you're tracking things on a certain spreadsheet? You want to review options with key management and those charged with governance. And you really want it should be a collective decision. And like I mentioned at the beginning of the webinar, this is really an opportunity to refresh the financial statements and notes. So if there's anything you want to change, now's probably a good time to do that. So for example, if you haven't previously shown an operating measure but you want to, that's an option. Or if you want to show more or less detail on the face of the financial statements, that's an option too. The presentation of the financial statements is key to educate the key stakeholders as well as the key users, because it is going to be a pretty big change. And then last but certainly not least, the financial statement presentation and conversion. And if you have an audit completed, this is something that you probably want to get your auditors involved in and discuss with them if it's applicable, and really look at your options and decide where you want to go. So that brings us to our first polling question, which I think Chrissy is going to help pull up. And that question is, what type of organization are you associated with? All right, so it looks like we've got a lot of education and a few handful of public or charity or private foundation, which I probably would have expected, and I'm assuming most of you all either have a June 30th or a 9/30 fiscal year end. So I will go back to the PowerPoint now. And so the next change we'll discuss is around functional expenses. So now all entities are required to show all expenses by both function and nature. So currently GAAP only required this for voluntary health and welfare organizations, and for all other not-for-profit entities, it was only required to show by function. So this is probably going to be a big change for most. There are certain items that are excluded from the functional expense determination, which includes the external and direct internal investment expenses that will now be netted against the investment return, which we'll discuss later on, as well as certain items that are typically reported in other comprehensive income in for-profit entities, such as a pension settlement, or if you do a bond refinancing and have a gain or loss, items such as that. So one question I've been asked a few times is, what exactly does by nature and by function mean? Natural expense classification is a method of grouping expenses according to the economic benefits received in incurring those expenses. Examples of natural classifications include salaries and wages, supplies, interest expense, rent and utilities, and depreciation. And a functional expense classification is a method of grouping expenses according to the purpose for which costs are incurred. And the primary functional classifications of a not-for-profit entity are program services and supporting services, which you may recall that I pointed out on the second example statement of activities that we had. And program services include costs related to the major purpose for and the major output of the not-for-profit entity. So these reflect activities such as research, education, student services, or auxiliaries. And then supporting services is really everything else, such as management, general, and administrative expenses and fundraising expenses. So the presentation, you have a few different places that you can show this information, which one is on the face of the statement of activities, and this is probably feasible if you have minimal programs or minimal expenses, but it is possible. Or you could show it in a separate schedule disclosure within the notes, or a separate actual financial statement. So you would add that fifth financial statement or fourth financial statement. And this is probably what I've seen most commonly done, and then the second being the schedule and the notes. And so now we can walk through a few different examples. So this example shows a few items at the bottom that are excluded from the functional expense requirement. So in this example, you'll see that this entity has two programs, A and B, as well as they have the supporting activities such as management in general and fundraising. And then they subtotal the programs and they subtotal the supporting to get to your total expenses on the right side. And then the statement of functional expenses or the schedule and the notes should reconcile back to the statement of activities. And so one of the items that was excluded from the expense section on the statement of activities in this case is the gift shop cost of goods sold at the bottom. So in order to tie it back to total expenses shown on the statement of activities, they've excluded that and shown a subtotal at the bottom. One thing I will add that I've seen so far with the entities that I have adopted is that there's been a fair amount of changes made to the statement of activities. Previously, an entity may have been reporting expenses or showing expenses on the statement of activities using a hybrid of function and nature. Now what we've been doing is really cleaning up and maybe just showing the program activities or supporting activities on the statement of activities and then showing the actual detail within this statement of functional expenses. There is no requirement for the number of programs or natural breakouts, so it's really just a concept of materiality and what you determine to be material programs to your entity. And I will say for the natural classifications like the salaries and benefits and depreciation and interest on the left-hand side, a good rule of thumb is that if there's a line item that's 5 to 10% of the total expenses, it should probably be broken out separately. So here's a second example. I'm sure a fair amount of you have seen the NACUBO advisory guidance for implementing the ASU, which is a really good resource tool, but this example is a little bit more simplified. You can still see at the top, it has the different programs. So in this case, it's education, research, auxiliaries, and student services. But instead of showing the breakout between MG&A and fundraising, this entity just decided to show the supporting activities as in total, which is completely fine. And one thing I did want to point out is that at the top in the gray, you can see that they've shown what's considered program expenses and what's considered supporting activities, which may be useful to identify what's really going on and to show what's going towards your mission. And like in the previous example, the total should be able to tie back to the statement of activities. And I know we've already discussed the definition of program and supporting, but just a little refresh. Auxiliaries typically include items such as housing, food services, and parking. And then your supporting activities include anything to support the primary mission and program functions, such as fundraising, executive management, finance, technology, general administrative, etc. And one more example, which is a little bit different of a format, is this third one here, where you can see they show the natural classification on the top and then the function on the left-hand side, whereas the previous ones, it's been reversed. And so either presentation is fine. I believe this presentation is in line with the iPad format. One thing we have seen a number of clients doing as well is using a similar breakdown that's required for the 990, just so it kind of matches up. And if you haven't used the statement of functional expenses or shown that breakdown before, and you do complete a 990, that's probably a pretty good starting point. And I do see we have a question. Let's see. For the person that asked the one question, I will circle back with you in an email after the webinar, but thank you for asking that. So there is a disclosure requirement related to this functional expenses, which includes a qualitative description of the methods used to allocate costs among program and supporting functions. And this should be done for major items. So it doesn't have to be everything under the kitchen sink. So in this example, it says costs of providing program and other activities have been summarized on a functional basis in the statement of activities. Accordingly, certain costs have been allocated among animal services and supporting services benefited. Such allocations are determined by management on an equitable basis. And so in this example, management determines that grants, salaries and benefits, education and awareness, and travel and other is allocated based on time and effort, that occupancy is allocated based on square footage, as well as depreciation on square footage, and then the remaining items are based on allocated using full-time equivalents. I will say that I haven't seen an other used in any of the entities that I've seen adopt, just because you don't necessarily know what goes into the other, and it may not all be on the same method of allocation. And this is one area where you may need to beef up and reevaluate the allocation methods, as well as get other departments involved to determine what the best method of allocation is. And for those of you that are audited, from an auditor's perspective, you will probably get more questions about allocation methods. There's no right or wrong answer, and what I've typically said is that as long as there's a documented, rational, or reasonable response, it's typically fine. For the person who asked the question about the difference between time and effort and full-time equivalent allocation, I believe a FTE is, a full higher salaried employee with benefits, and so that may be the difference in this specific example. I will circle back with you on that one as well. So just going over two more examples around the functional expenses. The first one is a narrative format, so you can see it describes the methods of allocation. So in this example, it says the expenses that are allocated include occupancy, depreciation, and amortization, which are allocated on a square footage basis, as well as salaries and wages, benefits, payroll taxes, professional services, office expenses, technology, interest, insurance, and other, which are allocated on the basis of estimates of time and effort. And I will say in this example, it does include interest, which for those entities that do have a material amount of interest, that's something that would probably be allocated to. Or there's another example shown, which is a little bit less, not as many listed, probably because they don't have as significant amounts of expenses. And I will point out in all three of these examples, there is a discussion or statement about the fact that management determined these allocation methods. So now the implementation plan for functional expenses. You'll probably see some similarities between the implementation plan slides, but first, general ledger and tracking considerations. If you haven't previously been keeping track of functional expenses by both function and nature, this may require some changes to how you record things in the general ledger. You also want to review and document those allocation methodologies, like I previously mentioned. Review the options with key management and those charged with governance, and kind of come up with, if there's more than one presentation option, which one you want to go through with, and then lastly, actually doing the conversion. And I've typically encouraged clients to do, or that we would help clients with, is taking your prior year information and doing a pro forma so you can see, play around with it and get comfortable with how it's going to look. So that brings us to our second polling question. So how far along in the implementation process is your organization? All right, it looks like it's fairly split. 21% with we should have started yesterday, 14% between 20 and 25%, 26% about halfway, 22% I can see the finish line, so kudos to y'all, and 17% already done, just here for the CPE, which is always welcome as well. So next we will go on to the probably one of the bigger changes around liquidity and availability of resources. And so for this one, I will say that I expected it to be one of the most significant and time-consuming changes, and I'm assuming a lot of y'all think the same thing, but it really hasn't been as bad as we initially thought. So hopefully that's some encouraging words. So the new disclosure requirements are going to require an entity to disclose both qualitative information that's useful in assessing an entity's liquidity, and that communicates how an entity manages its liquid resources available to meet cash needs for general expenditures within 1 year of the balance sheet date, as well as quantitative information and qualitative information that communicates the availability of an entity's financial assets at the balance sheet date to meet cash needs for general expenditures within 1 year of the balance sheet date. So you may be thinking, what exactly does that mean? So liquidity relates to types of assets an organization has and the maturity of those assets, as well as how an organization uses those items to meet current obligations within 1 year. Whereas availability speaks to what resources are available for use, which could be affected by its nature, external limits imposed by donors, laws, and contracts with others, or internal limits imposed by governing board decisions. So with this one, where do you start? Really, I would suggest the starting point is the quantitative piece. So the first thing you want to do is identify what your financial assets include. So what it does include is probably cash, restricted cash, investments, accounts receivable, pledges or contributions receivable, split interest agreements, beneficial agreements, and endowment assets. It does not include fixed assets, prepaids, inventory, and other illiquid assets. And so note, these are based on assets and liabilities are not included. And once you've identified these, then you need to determine which of these are available to meet cash needs for general expenditure within 1 year of the balance sheet date. So now we'll walk through a few examples and then go into the qualitative discussion. So first, we'll start with the quantitative piece. This example here is using a gross presentation method, which means it begins with your financial assets at the top, and then it backs out amounts that are not available for use within 1 year. So your financial assets include cash and cash equivalents, accounts receivable from students, contributions receivable, beneficial interest and trusts, assets held under split interest agreements, and investments. And then it backs out those amounts that are not available for general expenditure within 1 year, which includes restricted by donor with time or purpose restrictions, those subject to appropriation and satisfaction of the university's spending policy, and then board-designated funds set aside for specific uses. I will say the gross presentation method allows the reader to tie the financial assets back to the balance sheet or the statement of financial position, which should eliminate some questions. And the fact that you can tie the financial assets back to the statement of financial position, as an auditor, I always appreciate. But it's definitely not required, and we'll show a few other examples where you're not starting with showing all of your financial assets. But before we go on to other examples, one question that we have gotten is, what if you do this calculation and it gets to be negative? Generally, it shouldn't be negative unless you're borrowing from the endowment, from restricted assets, etc. But if you do get a negative financial assets available to meet general expenditures within 1 year, I would suggest playing around with different options and seeing if you're getting the same result, or it's just something that you may be missing or not taking into consideration. So here's another example. In this example, it's showing a net presentation. So you're not starting with all of your financial assets. You're really just showing those that are available to meet for general expenditure within 1 year of the balance sheet date. So this example shows financial assets available for general expenditure with or without donor or other restrictions. So those other restrictions might include board designations or other internal or non-donor external restrictions, limiting the use within 1 year of the balance sheet date. So that includes cash, accounts receivable, operating investments, promises to give, and that promises to give is probably those due within 1 year only, distributions from assets, distributions from beneficial interests in assets held by others, and then endowment spending rate distributions and appropriations. And hypothetically, when you play around with the different options, you should get the same bottom line number, but that's not necessarily a requirement. And so we'll go through another example, which is a little bit different of a option, and this one is also from the NACUBO advisory guide. So in this example, it shows information about financial assets available to meet general expenditures, as well as other sources of liquidity. And you can see at the top, it also has 2 columns for resources available and resources appropriated by the board. So it starts with cash above and includes accounts receivable and contributions due in 1 year or less, like I mentioned on the previous example, payout of donor-restricted endowments, payout on board-designated endowments, investments not subject to donor restrictions or board designations, and those are your financial assets. But then this example also shows the liquidity resources, so a line of credit or other commercial paper options, and it also states that there's no balance outstanding as of the balance sheet date. And then it shows the resources available and the resources appropriated by the board. So one more example of a quantitative part of the disclosure, and this is in a narrative format. So you'll see that this one has a total of $395,000 of financial assets available to meet within 1 year of this statement of financial position to meet cash needs for general expenditure, which consists of cash, contributions receivable, short-term investments. I will say that this example, the narrative format, is probably, I would only suggest it if you don't have a lot of financial assets. As an accountant or an auditor, I love Excel and tables. So I think that if you have a good amount, the table format's a little bit cleaner, but that doesn't prohibit you from using the narrative format if that's what you would prefer. And so now we'll go on to a few examples of the qualitative piece. So here is one that discusses liquidity and availability, and I will say that this is pretty detailed and one of the more detailed examples that I've come across. So in this example, it says that the organization has certain board-designated and donor-restricted assets limited to use, which are available for general expenditure within 1 year in the normal course of operations. It goes on to say that the organization has other assets limited to use for donor-restricted purposes and debt service. Additionally, certain other board-designated assets are designated for future capital expenditures in an operating reserve, and that these assets limited to use, which are more fully described in Note X, and are not available to meet general expenditures within the next year. However, the board-designated amounts could be made available if necessary. And that was one item I wanted to point out, that in this disclosure it is saying that, okay, here's what the board has set aside, but if we needed it, we could tap into it as long as we got board approval. This example also goes on to discuss liquidity management plan and how they invest their cash. And then at the very bottom it says the organization also maintains a $10 million line of credit, as discussed in more detail at Note X. And so the overall goal of the qualitative discussion is to communicate how your entity manages liquidity on a daily ongoing basis, as well as if it were short on cash and have an emergency. And the intent of this is to provide information that allows the user to understand the availability of your resources. So we'll go through a few more examples, but this is not the only items that are an option to use. If there's other things that aren't disclosed in this example that you can think of that's a liquidity option, you're more than welcome to disclose that, and we would encourage you. So here's one more example. I won't go through and read it in its entirety, but I did want to point out that this one does discuss how they manage liquidity on a daily basis. So they invest cash in excess of daily requirements in short-term investments, and that it also at the end says that there's committed lines of credit in the amount of $20,000, which could be drawn upon in the event of an unanticipated liquidity need. So unanticipated to me means if they're short on cash and they run into something where they need cash. This one's a little bit less detailed, but the ASU doesn't have a specific requirement on how long it has to be, so this could serve its purpose. And so here's one more example, trying to give you all lots of options. And in this example, it says that this entity operates with a balanced budget and it anticipates collecting sufficient revenue to cover general expenditures not covered by donor-restricted resources. This one also goes on to say that it discusses the board designations, and at the end of the second paragraph that these amounts remain available and may be spent at the discretion of the board. And then again, that there's a line of credit and commercial paper facilities available to meet short-term needs. So the implementation plan, what I would say is review financial assets and identify any limitations on availability for general expenditures within the next 12 months. Review the liquidity options and how your organization meets liquidity needs. We have been asked about whether a liquidity policy is required, and I will say the answer is no. I don't think one is required. Your auditor, if you have one, may say something different, but you are more than welcome to put together one and adopt one if you think that it's necessary. And if you don't have a liquidity policy and you're not sure of what liquidity options your entity has, I would suggest checking other policies that you may have as a starting point, such as cash management, debt, spending, etc. And so continuing with that, I encourage you to, especially on this one, play around with the different options, because what may be done first may not necessarily be the most accurate and what the users probably want. But I'm not saying the first isn't the best one, so just play around with it. And then lastly, just reviewing the options with management and those charged with governance, as well as your auditors, to kind of determine where you want to go and do the calculation using your prior year, just to kind of see where you anticipate ending up. So that brings us to our third polling question. So what change do you think will be the most challenging for your organization? All right, it looks like over half of the group is saying liquidity and availability of disclosures, which I probably would have guessed. And then coming in second is functional expense requirements, which that one was a little bit more cumbersome than I had originally anticipated, especially for those entities that weren't previously keeping track of that. So with that, I will continue moving along, and we'll go over some new and enhanced disclosures, and we'll be discussing restrictions on net assets, board designations, and new and enhanced disclosures for endowments, including underwater endowments. So first, On restricted net assets, you're now required to disclose information about the restrictions imposed by donors, including potential effects and the amount. So that means you'll need to show the composition of net assets with donor restrictions at the end of the period and how those restrictions affect the use of resources. So like we previously mentioned, this is the detail that goes behind the net assets with donor restrictions. So you either have the option to show that information on the face of your financial statements or in the disclosures. And what I've seen most people doing or most entities doing is showing the minimum presentation on the face and then going into more detail in the notes. We'll also need more disclosures on self-imposed restrictions, including board designations, which we'll discuss in a few slides. But first, just a few quick examples of what your net assets with donor restrictions note could look like. And this example is doesn't have that much detail, but it definitely, I think, meets the requirements. So you have those your net assets with donor restrictions subject to purpose restrictions, those subject to the passage of time. And then lastly, your endowments, including the accumulated earnings on endowment funds, so what was probably temporarily restricted in the past, and then the endowment fund held in perpetuity, which was probably what was permanently restricted in the past. And within the endowment, you could probably even go into more detail about what each of the fund's purpose is, but I don't necessarily think that's required. And then your total of $47 million would tie to what's shown on the face of the financial statement. And so here's just another example. Probably this one has a little bit more detail and another good option of the note disclosure for the net assets with donor restrictions. There is no requirement as to how much detail is needed other than that the amount and nature must be disclosed. So as I previously mentioned, there are new enhanced disclosures around self-imposed limits, including voluntary resolutions of the governing board to designate a portion of net assets without donor restrictions for purposes that limit the use of resources. So what does that mean? That means information about the amounts and purpose of board designations should be disclosed in the notes or on the face of the financial statements. And we have two examples of what this could potentially look like if it's not just shown on the face of the financial statements. So here's one where it's showing what your total board designated net assets are, which includes the board has set aside a piece for an operating reserve, the quasi-endowment, and then capital asset replacement reserve. And the total board designated net assets of $4.1 million may tie to the face of the financial statements if you just show what's board designated, but that's not required. And then here's another example, just one more from the NACUBO advisory guide. If you can't tell, I really like that resource. And in this example, it's showing all of net assets without donor restrictions as your footnote. So it has what's board designated and then what's non-board designated sitting in the net assets without donor restrictions, so net investment in plant and undesignated. And then your total net assets without donor restrictions would tie to the statement of financial position. And so now we'll talk about the endowment disclosure changes. So similar to the net asset change, your permanent and term endowment is now in the net assets with donor restrictions bucket, and your net assets without donor restrictions includes your board designated endowment fund. And so here's an example of what your endowment disclosure may look like. So previously you would have your unrestricted, temp, and perm. And so now you can see it's just the without donor restrictions and with donor restrictions. So your board designated endowment fund is sitting in the without donor restrictions, and then your donor restricted endowment fund is sitting in net assets with donor restrictions. So there's one additional change to the endowment reconciliation, which is that it removes the requirement to disclose separately investment income and net appreciation or depreciation of investments. This is going to be the same change on the statement of activities. So that means you will show all of that information as just one line item, investment returns net, and the net is net of certain expenses, which we'll discuss in a few more slides. And the purpose of this is that MIFA focuses on long-term perspective and total return versus the fluctuations that occur with unrealized gains and losses. So I think FASB thought just showing that one investment return net line item would be useful and more in line with the intent of MIFA. And so this is just an example of showing what that endowment reconciliation may look like. So you just have that one investment income net line item, whereas in the past you would have shown your investment income or unrealized gains and losses and realized gains and losses separately. So there are a few changes to the underwater endowment. So first, just a reminder, an underwater endowment is defined as a donor-restricted endowment fund for which the fair value of the fund at the reporting date is less than either the original gift amount or the amount required to be maintained by the donor or by the law that extends the donor. And underwater endowments are now considered to be with donor restrictions. So in the past, if you had an underwater endowment piece, you were probably reclassifying that portion to unrestricted net assets, but now that's no longer going to be the case. It's just going to remain in the net assets with donor restricted bucket. And in addition, you will also need to disclose, if you haven't already done so, the total fair value of the underwater endowment funds, so the total dollar amount, the original endowment gift amount or level required to be maintained, and then the amount of deficiencies of the underwater endowment funds. So this is going to be both the number of funds that are underwater as well as the total dollar amount. And then you'll also need a description of the governing board's interpretation of the law or laws that underlie the not-for-profit's net asset classification of donor-restricted endowment funds, including its interpretation of the ability to spend from underwater endowments. So now we'll just go through a few examples of what that may look like. So in this example, you'll see in the first sentence, it says that a donor-restricted endowment fund is considered to be underwater if the fair value of the fund is less than either the original gift amount or the amount required to be maintained by the donor or law. And it also goes on to say that the college has a policy that permits spending from underwater endowment funds depending on the degree to which the fund is underwater unless specifically prohibited by the donor or relevant laws and regulations. So your entity may have a different spending policy, which is completely fine. It just needs to be disclosed. And then this example also shows the original gift amount, then the aggregate fair value, so what it's currently valued at, and then the total amount underwater. And this is another example that you'll see. It details what the total amount of the underwater endowment is, so that there's 14 funds that are currently underwater, and that's what the original gift amount was, the current fair value, and then the deficiency. And then the second paragraph goes on to disclose what the policy for spending underwater endowments is. So as you can read through in this example, it's a little bit different of a policy from the first one, so it's really going to vary by each entity. And so what does that mean? What's the implementation plan? Similar to our previous ones, you're going to have general ledger and tracking considerations. So is there any underwater amounts that are still currently sitting in unrestricted net assets that need to be reclassified back to net assets with donor restrictions? Compiling the information needed for the required disclosures. So do you need to review any of the board designations with the board and talk to the board about what the policy on spending underwater endowments is, and then actually going through the examples and determining what you would like to proceed with. And so just lastly, just a few other quick changes that I'm going to touch on very briefly. First, the expiration of capital restrictions, then investment expenses, and the statement of cash flows. So this may not be a change, but going forward, unless donor stipulations limit the use of the assets for a period of time or for a particular purpose, donor restrictions on long-lived assets or cash to acquire or construct long-lived assets are considered to have expired when the assets are placed into service. So that means that the restriction is considered to be released when the asset is placed into service. So if you were previously doing it as it's depreciating or as the cash is spent, that's no longer should be the case. And then the second other change, as we previously mentioned, is that investment returns are now going to be reported net of related external and direct internal investment expenses, both on the statement of activities and the endowment reconciliation. So you no longer need to break out realized and unrealized gains separately. I think external expenses are probably pretty straightforward and include things such as an investment manager, but I know that there's some questions on internal investment expenses. So what does that mean? Direct internal expenses are considered to be items that involve the direct conduct or direct supervision of the strategic and tactical activities involved in generating investment return. So the key is generating investment return. So examples of that are employee costs, including salaries, benefits, and travel, et cetera, for the staff responsible for the development and execution of investment strategy. So the CFO's time or the chief investment officer's time, if you have one, as well as costs related to internal investment management, including costs associated with internal investment management and supervising, selecting, and monitoring external investment management firms. So internal expenses, this does not include items that aren't associated with generating investment return. So that does not include your monthly and quarterly reconciliations and the time spent to unitization. That's items that aren't really assisting with generating an investment return and should not be netted. Those would be shown in another bucket. And the goal with this is to provide a more comparable measure of investment returns across all not-for-profits, as well as to eliminate difficulties and related costs in identifying embedded fees and related inconsistencies that are reported. And so the last change we're going to talk about is cash flows, and I don't think this will probably have a big impact on most of y'all. So now it allows for the use of the direct method or the indirect method, and if the direct method is selected, you're no longer required to present an indirect reconciliation. And so this is just two examples of what the statement of cash flows could look like using the indirect or direct method. So implementation plan for these other changes. What do you need to do? So first, you want to compile information required for those new and enhanced disclosures. And if you're using the indirect method on the statement of cash flows, determine if it would be useful to switch to the direct method. Determine if there is an adjustment needed for previous accounting treatment of the release of restrictions. And then lastly, look at those. If you do need to make some changes, look at the options and review those with those charged with governance and managers and your auditors, and see what that's going to look like going forward. So with that brings us to our fourth and final polling question, which is, do you feel ready to implement the ASU? So almost 90% saying yes, true, and I'm happy to hear that. We've done a number of webinars on this, and hopefully they've helped. And so that's good. And there's just one or two more things that I wanted to touch on, and then we will wrap up for the day. Okay, so like I previously mentioned, I've had a number of clients that have adopted this or even early adopted this. So the question is, what have we learned throughout the adoption process? So first, don't underestimate the reporting time for especially the functional expenses and liquidity and availability disclosures. And also consider the education to the audit committee and the fact that you'll probably or should probably set aside more time than you usually do when the auditors come in case your audit committee members have any questions about the change. One thing that would help is being proactive and showing and discussing the changes ahead of time with them. We kind of touched base on this already, but the liquidity footnote should probably be positive. There are situations where it will be negative, but if that's as I mentioned, you want to play around with the options and make sure that that's the case. For your board designations, I can encourage you all to review old designations and go through those with the board members. And you also will need to decide what you want to disclose and what you don't feel is necessary to disclose. Functional expenses is no longer optional supplementary information. So if you go through an audit, there will probably be a little bit more testing over the allocation methodologies. So you want to make sure those are documented. And focus on the major allocations. So really don't need everything under the kitchen sink, and you really want to spend time on what matters. And also consider aligning your functional expenses with the other reporting requirements you may have, whether it's the 990 or IDES or something else. And then improper classification of earnings on endowments, and that earnings can be used for operations. You just want to ensure that those are sitting in net assets with donor restrictions and not net assets without donor restrictions. And that those accumulated gains should stay in with donor restrictions until they're appropriated out. And this is an opportunity, if you need to clean up the endowment. And then last, the key, I just want to encourage you, the ASU gives a lot of opportunity to use different options, and the ASU is open-ended on a lot of things, so just play around with it, and it gives us some flexibility. So I encourage you to try out a number of different options for your entity to see what you may like the best. And so with that, let's go through and implement the ASU. And as always, if there's any questions or concerns that y'all may have, please feel free to reach out. And I know that there's some questions that I didn't get to in the questions pod, so I will reach out to y'all at some point in the next few days to follow back up. So thank you so much for participating, and hopefully this was helpful, and good luck.